Hello, everyone, and welcome to In the Room with Guinness Global Investors. I am your host, Arifa Essop, and today we are chatting to Ian Mortimer, Portfolio Manager of the Guinness Global Equity Income Fund. Hello, Ian, and thank you for taking some time out from your busy schedule to come and chat to us.
Delighted. Happy to be here. Thanks a lot, Arifa.
Thank you. So tell me, Ian, how did you end up in the world of asset management? Was it always a plan?
Not necessarily. I think so. My background was actually as a scientist. So I studied physics at university in London, first of all, and then actually went on and did my PhD, also in physics. And I was looking at sort of nanotechnology effectively. So it's something called carbon nanotubes, which is a form of graphene, for those who are interested. And I sort of followed that path partly for sort of family reasons, I suppose. So my father was an academic. My mother was a sort of hospital pharmacist. My brother had just done a PhD in maths, so it felt like the thing to do. And I really enjoyed it. It was great. But it was not something I necessarily wanted to do forever, in the sense of becoming an academic. And I'd always been interested in sort of businesses, and companies, and how they worked, and who earned the money, and what they were selling, and how it was all put together. And I think I then sort of thought about that, and then thought about the kind of skills I might have. And then asset management or investment management seemed to fit really, really well, because you got to sort of apply a sort of the idea, I guess, of the sort of science, which is it's not maths, right? It's not perfect. You don't know everything about something, and it's about coming to getting lots of data and trying to come to conclusions and see how things interact, and understanding that it's pretty complicated, and quite probabilistic in the sense of it's a fairly kind of chaotic system, lots of people trying to make lots of decisions with lots of influences. And rather than trying to work that out perfectly, it's trying to figure out, how do you increase your chances of a good return, and understanding that there's luck and other things involved. And so that seemed a really good fit. And then ultimately I got incredibly lucky. So I was applying for roles at Guinness Global Investors. This was back in 2006. It essentially just started. They were founded in 2003. By our founders, I can talk about. And so I joined pretty early on. So I think I was employee number 6, I think, or 5. So it was pretty small. It was a bit of a startup type approach. And I managed to sort of hit the ground running, which was great because we've got a lot of autonomy. It's quite a lot of figure it out. When I joined, it was sort of the 6th analyst, if you like, was the dog, who was our founder's pet, right? So we've changed a lot since then, and I've learned a lot along the way, which has been brilliant. So sort of that's the story, really. It was sort of scientific background, and then thinking about how I might apply those skills to sort of looking at businesses, and it's been a great choice. I've thoroughly enjoyed it. It's a really fascinating area to be in.
That's interesting. So 2006 Guinness Asset Management. Any reason why you've stuck it out, or did you choose? Did you want to be at any other asset management? Was there a choice? Was there ever a choice?
They're the ones who would have me. That was probably the point. But no, no, I think it's going back to kind of where we started. So to kind of get a bit of context about who we are. So our founder is a guy called Tim Guinness. Therefore, that's why we're called Guinness Global Investors. And his story is really interesting, and he's actually part of the Guinness brewing family. So sort of his great grandfather was Arthur Guinness. Although he would describe himself as the part of the family is the working Guinnesses. So he didn't necessarily. There was sort of bits of the money went one way, bits of the money went somewhere else. So we don't work with Diageo or anything like that. But that was his sort of backstory. And he actually had founded previously a different firm, a different asset management business in the late 80s through the 90s that was really successful in the UK. Ultimately got bought by Investec, in fact, who I'm sure you'll all know. And they took that on. He worked there for a little bit. And then ultimately, he's a very entrepreneurial character. So he said, I've sold this business, I want to start a new one. And so I think what was really exciting when I joined was it was pretty small, but I was working directly with Tim Guinness, who was a sort of well-known fund manager, had lots of experience, had run and built a business. And so in those sort of early days, the sort of the learning curve was incredibly steep. We got lots of responsibility. I got to work directly on funds and looking at companies straight away. And I got to understand a lot of the rest of the way the business is put together. So, there's more to it than just picking funds. We've got to talk to clients, got to think about what's going on the macro side, think about marketing, got to think about like what products we're running, how they're going to, where do they fit in clients' portfolios. So that was sort of a really interesting period. And then ultimately, I started working with my colleague Matthew Page, who actually joined the firm the year before me, so he was 2005. And we started working together in 2009, kind of post the financial crisis. And we had a view in the firm that we wanted to grow. And to grow, we wanted to launch new funds. So ultimately, we were, asked, if you come up with new products and we think they're really interesting or we believe in them, we can seed them and we'll launch them. And so Matt Page and myself spent a lot of time, about a year through 2010, kind of building and designing the Global Equity Income Fund. So blank piece of paper, we got to put down, what it is we thought the best way was to run money for that strategy. We got to put the whole thing together ourselves. So very much sort of our DNA in it from the very beginning, and we launched it. And that's super exciting for relatively young analysts, if you like, becoming portfolio managers. And you've got to sort of live or die by it, right? The numbers don't lie, and we got to put our name on it. So when we launched that fund, I think it had $500,000 of seed capital. So it was tiny back in 2010. And then we've managed to kind of grow it over time. So we're that strategy now, Global Equity Income Fund, is about $6.5 billion US. We've got clients all over the world. We've built up a really great team of analysts. So we've got now 5 analysts working for us. There's 7 of us. And so really the reason we stayed so long was because we managed to, keep growing and doing new things. And I think kind of that idea of sort of building a business within the business, if you like, and then helping the rest of the business grow, has been brilliant, and it's sort of, I can't, that opportunity and ability to do that, I think would be pretty difficult somewhere else. And I think the culture is super important. So, it's very much sort of investment focused. It's all about, providing the return profiles for clients that they can understand and that we can do that over long periods. And crucial to that is we own quite big equity stakes. So I own about 7.5% of the whole business, which we figured out a long time ago. And lots of the senior fund managers do too. So that means you're really incentivized to do the right thing, to do everything organically and successfully. And that means you've got a bit of a, stake in the success. And also it means your sort of
vested interest.
Yeah, and your career risk is not so big, right? In the sense of if you're in a big firm, I guess the problem is if your performance is bad for 6 months, 12 months, maybe they give up and the marketing team goes somewhere else and, do better, chase this market, and it can be difficult. Whereas we know this is what we want to do, this is how we're going to achieve it. There'll be periods where our style will be out of favor and we'll underperform. And that's okay, as long as we keep doing the right things. And if we do it consistently over long periods, then actually you end up with a better return often than some of your peers. And that's ultimately what we've shown. So really, I say very low turnover of staff, really good people, and everyone's sort of facing in the same direction. So it's a really encouraging environment, and I think being able to grow within that has really kept our interest because there's been so many things to do and build and work with new colleagues.
So you were talking about consistent returns. Does Guinness have a preferred investment style when it comes to investing? And does that differ to what your personal style may be?
Yeah, I would say, I mean, we run lots of strategies at Guinness, and they're of different styles, and there's multi-asset funds and thematic funds, and obviously the global funds that we run. But I'd say if you were trying to take a sort of big picture view, what we're trying to do, I would generally say we're value biased. So that's not necessarily we're value in terms of deep value, but value biased in the sense of even within strategies that are looking for growth companies, we'd always be conscious about, well, how much are we paying for that growth? What is the valuation we're placing on this business, and does it seem excessive? And so therefore we're avoiding kind of fads. We're not chasing kind of startup type companies, and it's really looking for those sort of good businesses at reasonable valuations. And within our team, I'd say we have a pretty high quality bias within that style. The other thing I would say is we would try and be somewhat contrarian in the sense of trying to think, longer term is probably the big way to do that. Markets are really focused on the short term. What did Trump say yesterday? What's the Fed going to do next month? And actually, we're trying to take that thing about, the best way to get the best returns is if you could look, 3 years out, 5 years out, and think about how's that going to build out in the long term, and let's try and avoid a bit of that noise. And then the final thing I would say is the concentrated portfolios. So if you look across our firm, portfolios are generally made up of about 30 to 40 stocks. So we don't have 100 stock portfolios, long tails. So they're pretty concentrated, and the vast majority of them are approximately equally weighted. So we have again, sort of quite a different way to think about portfolio construction, and we think that's got a lot of benefits. So I'd say big picture, it's sort of value biased. It's the long-term view, and then it's kind of concentrated portfolios with high active shares.
Okay. So Ian, for the benefit of our audience, can you tell us what the difference is between a general global equity fund and a global equity income portfolio?
Absolutely. So I guess the first thing is, I mean, in very simple terms, a global equity income strategy is focused on companies specifically that pay dividends. So you're looking to generate from your total return a good proportion from the dividend that you would receive from those companies. So generally speaking, you're looking at above average dividend yields, whereas for a global standard, if you like, or a non-income global equity fund, it could be of all different shapes and sizes because it's a pretty broad description. So you could be global equity and you're focusing on deep value stocks. You could be global equity and you're focusing on high growth. You could be global equity focusing on core. So I would say, there's lots of different styles of global equity funds, but you would not necessarily be limited, if you like, by whether the company pays a dividend or not, I guess is the big difference. And I think global equity income, it's sort of the best way to think about it is it's like a strata, if you like, of a global equity. So if you have global equities, and within that you could have value, growth, you can have income, and other sort of strategies within that. But really, what we're trying to do is capture the kind of the dividend factor, if you like. So when you're talking about global equity, is why would you buy a global equity income fund? I guess it's the idea that it's quite well established, lots of evidence. Dividend paying companies outperform the market over long periods, much like kind of high growth companies outperform the market, over longer periods, or value companies, in terms of the factors we're looking for. So what we're trying to do within global equity income, and I take other managers also, is saying, hey, dividend paying companies can outperform over the longer term, and that's what we're trying to capture. And there are different ways of doing it.
And earlier on, you spoke about equally weighted portfolios. How do you get that right? Because you've got 30 to 40 stocks in there. How do you know which some are better or not better, that you just want to equally weighted? Why that decision?
Yeah, so I guess it's a fairly long answer to that. I mean, in the Global Equity Income Fund, we have 35 stocks. And I think it's two things we've got to think about here. So the first is we have consistently 35 companies all the time. So whenever you look at our portfolio, it'd be 35 companies. And then they are
Okay.
equal weighted. So therefore, each position is about 3%. And the reason that's important is, firstly, if you have a set number of positions, it instills a lot of sell discipline. Because if I want to buy something, we've got to sell something to make space. So we're constantly looking at kind of, so I think probably as a fund manager, it's quite easy. It's probably easier to see the shiny new thing that you're excited about, that you want to buy. And it's maybe harder to look at the thing in your portfolio that's not doing so well, or it's done really well and it's expensive and you really should be moving on. So what that does is, it avoids that behavioral bias, if you like, that sort of anchoring bias of forgetting about it. So that's really important part of the first thing. If you then say they're equally weighted and a set number of positions, you will then always have about 3%. First thing is we want to avoid sort of regret bias. So when we buy a position, it kind of goes straight up to 3. And when we sell a company, it kind of goes straight down to 0. So we're not trying to kind of creep up, well, that might be interesting, basis points, then we buy 1. Yeah, because often, when you make your decision, that's the right time. So that's the first thing. It then, importantly, we think reduces stock-specific risk. So what you'll never see in our portfolio is positions that are sort of 7, 8, 9%. Because obviously that, if that goes well, that's great. But if that doesn't go so well, you can see quite, significant drawdowns. And so we think it strikes the right balance between benefits of diversification. 35 stocks gives you a lot of diversification benefits, and it avoids stock-specific risk. And then what we're then doing is, with our portfolio, we don't rebalance sort of every. It's not perfect, right? Because that was a lot of trading costs and drag. What we're generally doing is the bulk of the portfolio we don't touch, because it'll be approximately equally weighted. Say it's between 3 and 3.5, or 3 and 2.5. So that's fine. So that limits trading costs. That already gives you the benefit of reducing some of the costs sort of inherent in running the fund. And what we're then doing is actively looking at those stocks that have outperformed and those stocks that have underperformed, and trying to think about the idea of letting your winners run. So if something's doing well, you want to kind of keep letting it do well and not just take money off the table, but not to the point where it gets too big, because probably at that point it could be more expensive. The market could be very excited about it, and maybe it sells off a bit. And equally, on the other way, you don't want to water your weeds, right? You don't want to just keep adding to a company that's doing poorly because it had poor results yesterday. You want to kind of wait, happens. But what you don't want to do is forget about it. So if it sort of drops below 2% of our portfolio, we have to sort of make a decision. Do we want to, do we still think this company's valid in the longer term? Or actually has something changed and we should be moving on? Therefore, we have to put money to work, or we have to sell it. And all of that process means we have a very good guide to trying to make good decisions. So it's all about giving a structure to the portfolio, embedding all of these good things to avoid the behavioral biases, and then ultimately trying to go, look, this is the sort of decision you should be making now. Do it, rather than, maybe you do it, maybe you don't. So we have set meetings every week to think about this, and it gives us a really simple, clean way to think about to making those decisions with sort of less noise. The other thing I would say is we did a lot of work doing kind of Monte Carlo simulations. So we did sort of randomized 35 stock portfolios, and we looked really carefully at when does it add value? Is it daily rebalancing? Is it yearly rebalancing? Anything in between? We found about quarterly gives you the best total return. So that's another sort of framework to think about. So if we don't do the whole portfolio like that, but individual names, if maybe we hadn't, it's been doing really well for 4 months and we haven't rebalanced it, we might then think, well, actually, in that time scale, that's sort of maybe so that can kind of add to our thinking. And the other part of that work that was really interesting was the period where rebalancing adds the most value to your long-term total return is in periods of really bad sort of equity market distress. So things like the financial crisis. So markets, some big shock, everything falls the same way, regardless of whether it's impacted or not. So therefore, if you can kind of top up those stocks around those levels, when the market comes back, that you can get a really big rebound. And so that doesn't mean it's sort of perfect, right? It's not like the magic, we know when the bottom is. But what it does do is when the pandemic hit, we had stocks that were down 30 or 40%. We did not know what was going to happen in a global pandemic in the next 6 months. But what we did do was be able to have a conversation and just say, hey, look, this thing's happened in markets. We've got stocks that have fallen 30 or 40%. What we know is it's an exogenous shock. We should be at least thinking about rebalancing. And I think that gave us some confidence to look at those companies and say, hey, this is an insurance business. People haven't, in Japan, people do insurance a lot in the post office and they physically sign stuff, so they can't do it. Is the insurance business in Japan completely changed because of a global pandemic? And you say, no, right, we should be topping that stock up, right? So it's all about trying to have a good structure that we thought about in advance about why we're doing it carefully, and then using that structure to make these decisions, but having enough flexibility to, hopefully add value through, thinking and understanding. So it's not quantitatively driven. It's just giving you good guide rails so you don't stray off and make those mistakes that, can be quite detrimental to kind of how you run your portfolio.
Great. I want to ask why 35? Where do we get to the magical number of 35?
Yeah, I mean, it's, you can, if you want to sort of think about diversification, right? In a very simple terms, if you've got a one stock portfolio, you've got no diversification. Right? It's 100% based on if that company does well or badly. Results come out, it drops 10%, your fund's down 10%. And it's, it'll be completely linked to one sector, right? You buy a utility stock and interest rates change, it'll be completely correlated to that. If you buy two stocks, your diversification is then 50%. If you buy three, it's then 30%. You buy four, it's 25%. And if you go up that curve, if you plot that on a graph, you see the benefits diversification shoots up at the beginning. 1, 2, 3, 4, 5, 10 stocks, and it keeps going, and then it kind of plateaus out around, it starts to kind of turn around 20, and then once you get above about 40, 50, it gets pretty small, the benefits, because it gets 50 stocks or 100, it's 2% opposite. It kind of really levels off, and if you get to 500 stocks, it doesn't really have much, right? And so what we're trying to do is look at kind of where does that curve occur? When's the flattening out happen? And it's sort of somewhere around between sort of 25 and 45 stocks. So we think 35 is a good sweet spot between those levels. And it really means you've got diversification in terms of sectors you can put in, geographies you could use, different type of companies with different economic drivers. And then the stock specific risk is kind of limited to about, say 3 or 4%, say. So therefore, if anything goes really wrong and a company that falls 50% for some reason overnight, you've got a kind of 1.5-ish% impact, which is about right. But on the flip side, if things go really well for a company, you can have meaningful contribution to returns. So it's all about just where is that balance, and it's somewhere around that level. And we think that's kind of appropriate. And also from an income perspective, by the way, we're all talking about dividends. We've got a big group of companies. They're all paying a dividend into the pot, right? So over the year, all these companies are putting in their little dividends into the pot, and that pot's growing. And that's really helpful too, because again, if you had one company, you get that dividend, and if something went wrong, they'd cut it, and so on and so forth. So that's kind of why we're thinking about 35 companies.
Okay, I'd just like to remind the audience to please put your questions in the Q&A box for us. Thank you. Ian, tell me, why should the average investor care about dividends?
Well, I think they're very important. Ultimately, I think they can They can firstly they can tell you quite a lot about the company. So if you think about companies generate cash, what do they do with it? They've got different choices. They can reinvest back in their business to try and grow it. They can pay down debt if they've got more debt. They can buy back shares, or they can do dividends. And so the first thing to think about it's part of your kind of capital allocation decision, right? It's not this sort of esoteric. Some companies pay dividends, some don't. Kind of what is it? It's just this thing. It's management teams sitting around and boards and saying, do we, want to, what do we want to do? So first thing to think about is I think there's good evidence to suggest if companies pay dividends, their general other characteristics can often be a little bit better. Because they're less profligate, So if you're a sort of company, just get big quick, right? Just take all the money. I just want to build an empire. I don't care if it's any good or not. I just want it big as possible at the extreme. But if you've kind of got your cash at the beginning of the year and you're saying, right, what should we do with it? Well, the first thing we do is say give some back to shareholders. You've kind of got less money to think about. You're more concentrated on what you're going to do with that. So that's the first thing. Kind of what is it? Capital is part of your capital allocation decisions. And then the second thing, kind of more important ultimately, is we think dividend-paying companies can outperform. So sort of going back to my sort of comments at the beginning. So there is a lot of evidence to show if you take the subset of companies that pay a dividend relative to the market over long periods, they can outperform. And often that outperformance comes with slightly lower volatility because the businesses that pay dividends generally, on average, wouldn't necessarily be your kind of volatile small cap stocks and your early stage type businesses. So that's interesting. Within that, though, what you've got to be careful about is not all companies that pay dividends are created equally. So if you pay a flat dividend over time, you do about the same as the market. So it doesn't really, you don't outperform, but you don't underperform necessarily. If you cut your dividend, you tend to underperform a lot. That's a real flag for markets if you cut your dividend. But the last set of dividend-paying companies are those that sustainably grow their dividend over time, and they are the ones that drive the outperformance of the overall dividend factor. So when you're thinking about equity income and companies pay dividends, if you want to outperform from that factor, you want to find those companies that can pay and grow their dividend over time. So that's really where we're trying to look. And if we think about what return profile that again gives you, is that you would say, generally speaking, dividend paying companies maybe are a bit more mature on average. They're probably not growing quite as fast, but you can see good growth. And if you think about what that means in terms of your total return, we think there's a good opportunity to get both capital growth, although maybe not as high as a growth portfolio, right? But reasonable growth, and you can get your income alongside. So those two things are adding to your total return over time. It's not just the dividend you're going to get; it's you can buy companies that are growing because they're the ones that are going to pay the sustainable dividend. If you've got a good business that's growing nicely, not necessarily really fast, but growing nicely, it's growing, it's reinvesting its business, its cash flows are getting bigger every year. Every year it pays some of that out. That dividend then can grow alongside the growing business. What that means is these types of businesses are really, if you can buy lots of them in a portfolio, it tends to mean you end up with a portfolio that can do quite well in lots of different market environments. So generally speaking, it would outperform if markets fall. It's generally more defensive. So that's a good thing, right? Lots of ones like that.
Yes.
Protection on the downside. However, it can also keep up pretty well in rising markets. If it's a big growth rally, AI rally we've just seen at the beginning of this year, you're not going to capture all that upside. A lot of those companies don't pay a dividend. But you can have pretty positive returns, which is also good. And if you build that combination up over time, you tend to have a lower volatility, but actually your kind of risk adjusted returns look really good. So you can get a really nice outcome with maybe taking kind of less ups and downs, if you like. And alongside, you're going to get this nice regular income stream. And I think if you kind of think about that as an investment sort of return profile, I think that's a really, really attractive one for lots of different types of clients.
Are there particular types of companies or sectors that tend to be better for dividend investing?
Yes, I would say so. In general, right? There's always exceptions to the rule, but the thing to think about is, firstly, what I would say is there's sort of different types of equity income fund. Firstly, so I think often the kind of traditional equity income fund, if you went back, or what actually there's quite a lot today as well, by the way, is the idea that what you want from your equity income portfolio is a high dividend yield. That's the main thing I want to see. I want to see a 5% dividend, and then my client can get 5% every year, and it's kind of bond-like, and I've got some equity exposure, and that's great. Now, if you take that approach, what tends to happen is you'll be very skewed to certain geographies and certain sectors, because not all, let's just take geographies first. Let's take my home market, the UK, which actually, by the way, is quite similar to the South African market, in fact, whereby you have quite high dividend yields on offer from a lot of the companies. But the company sort of sectors are quite dominated by a few sectors: utilities, the banking sector, and commodities, so energy, materials type businesses. So the FTSE is full of those, has a high dividend yield. Those companies often have a high dividend. So firstly, from a sectoral perspective, if you just screen for a high yield, you're going to get a lot of kind of real estate, utilities, commodities type businesses. However, so that's first thing. Second thing is, if you went kind of globally, you would see certain regions like the UK or South Africa would generally pay those high dividends because of the sort of sector structure and the history that a lot of clients in those regions like the income, so a lot of companies pay it. Australia would pay quite high dividends on average, again, quite bank and commodity business, but I think they also have some incentives from a tax perspective for individuals receiving, because they have what's called franked income, so you don't have to pay tax on some of it. So that's why a lot of companies are encouraged, are incentivized to pay those high dividends. And then you have a few other anomalies, like Brazil is an area that actually pays quite a lot of dividends too. So you kind of get a bit of a skew there. Then if you look at the world's biggest equity market, which is the US, you'd be underweight, because in the US, the dividend yields on offer are generally lower. And the reason they're lower in the US is that there's a higher proportion of buybacks. So in the US, they have this thing called the safe harbor rule. It was in the late 70s. And there is a kind of tax incentive for companies to pay buybacks rather than do buybacks rather than dividends. So when you look at it on average in the US market, the dividend yield is probably half that in Europe. But if you added in the amount they did on buybacks, it's probably about the same, if not a bit higher. So you have all these kind of structural differences. So if you just take that very simple view of, I want a high dividend yield, and I just take my MSCI World benchmark and I rank it highest yield to lowest yield, and I just buy a bunch near the top, you'll get a high dividend yield, but you'll be very overweight Europe, overweight UK, Australia, underweight US. You're often going to have lots of utilities, lots of banks, lots of real estate, lots of commodity companies. Now, that's one way of doing it, but what we think is the risk there is, are you going to get a lot of capital growth? Are utility companies a good place to see, kind of growing revenues and building out assets and kind of compounding? I think unlikely not. Some of these areas are really regulated, like the banks. They're areas that often cut their dividend a lot over time. So bad happens, they cut the dividend. And then commodity companies is completely outside their control. Right? If the copper price goes up or the oil price goes up, that's great. If the copper price drops or the oil price drops, they often reduce their dividend and or again that capital growth. So I think if you take that example of high yield, you skew to certain areas, sectors, skew to certain geographies, and you probably give up a lot of capital growth. And by the way, that big income stream you're getting, you're quite likely not to get it just when you need it most. Markets fall, pandemic period, for example, you just see dividend cut after dividend cut in those areas. What we're trying to do is,
I want to
sorry.
No, go ahead, Ian.
So
Thanks.
I was going to say, so that's your first, so that's the sort of, that's how you think about it. Now, if you took an approach where you said, rather than trying to get a high dividend yield, let's just get a moderate dividend yield and look for dividend growth. Because actually, it's that sort of idea of compounding again. If you started with,
Mhm.
you've got your high dividend yield that's flat over 10 years, and you start with a dividend that's sort of half that, you only, if you grew that 7% a year, that dividend, by in 10 years' time, you're going to have exactly the same income as the high yield one that didn't grow. And you're going to have seen way more capital growth underneath as well. So your total return is going to look way better. And so what we're saying is we just lower the bar that we're trying to look for in terms of that outcome of the dividend. We still have a premium to the MSCI World Dividend, but we lower it and we say, actually, I'm happier to buy a more, a more moderate yielding company if I can see that dividend growing. Because I know that gives me a good combination of capital growth from the business, a good business, and I'm going to get that income. And the kicker is the income's growing. So as soon as you do that, all of a sudden the sectors we look at expand a lot. We can find good IT companies, we can find good industrial companies, we can find good healthcare companies, we find lots more opportunities in the US market. And all of a sudden that completely changes, which means when you look at our portfolio, we can find higher quality companies that are less likely to cut their dividend, more likely to grow it, and is more diversified and can capture better economic growth. So when markets rally, if you look over the life of our fund, we've kept up really well when markets have been growing quickly. We've owned IT companies like Taiwan Semiconductor or Broadcom. We've owned Microsoft since we launched. Things like Cisco were growing their dividend like 20% when we bought it in sort of 2012. We've done really well out of, lots of companies are paying more moderate yields, but growing them quickly. And I think that's the better combination. So when you think global equity income or equity income, be cautious if the yield's too high, because you might not get it. And then think about what is the return profile I want from this type of investment. We would argue that sort of moderate yield, growing income, think about kind of quality compounder type businesses that can do well in lots of different market environments.
So what you're saying is about finding the balance between capital growth and dividend yield.
Absolutely. Absolutely. Spot on. That was a much quicker way.
Okay.
Well,
About summarizing it. Ian, what are some of the common risks associated with dividend investing, and how would you manage that risk?
so the first one I would say is that stretch, as we've just been talking about, that kind of stretching too high for high yield. And there's a great chart. You can see that basically just buckets companies in terms of the size of their dividend yield, sort of 0 to 1, 1 to 2, 2 to 3, and it goes all the way up like this. And if you look at kind of consensus estimates, right, you can see like what do people think you're going to get for these. If you then go back in hindsight and say, what did you actually receive? You just see like the higher the yield you're expecting, the less likely you are to get it. Right? And clearly, if you think you're going to get a 20% dividend, that company's massive distress, right? You're not going to get it. But as soon as you get above 5 or 6%, a good proportion of those companies, you don't receive it. So that's what you're trying to avoid. The big risk is dividend cuts, because dividend cuts kill you because the market is anticipatory. So if you're holding a company and it cuts its dividend, you probably felt the pain already. Markets see that coming often, and the share price of that company tends to fall quite a lot in the sort of 6 to 8 months before the dividend cut is announced. So all through that period, your yield is going up, right? The share price is coming down. Your dividend you're expecting is going up and up, so it's more attractive. Think, oh, good, I'm going to get this. And then just the last minute, they cut the dividend, and you're left with a stock that's underperformed and one that's unlikely to outperform for a while too, by the way. So how do you avoid dividend cutters? So the first thing is be very cautious of high dividend yields, telling you a bit about the distress of the company. The second thing is people often look at things like the dividend aristocrats. So how many years have you paid a dividend? Well, if you paid a dividend for 25 years, we think, it's much more likely. And there's some evidence that helps, but the correlation is actually not as good as you think. There's loads of examples of companies that paid a dividend for years and years and years, and they probably shouldn't have done near the end because actually their business adapted or changed. Things like payout ratios people look at. So kind of the proportion that your dividend is of your earnings. So if it's kind of lower, you think that's pretty safe. Lots of earnings, dividends, a small proportion of that, that's fine. Problem with that is earnings change very quickly. So the extreme example was the pandemic. You had lots of earnings, your payout ratio looks perfectly fine. All of a sudden, you've got zero earnings, and your payout ratio has just exploded, right? So they're not that helpful, and they're often the sort of the metrics are often used and quoted. What we did is when we're launching the fund, we did loads of work, as I said, before we launched. And what we found, it was actually return on capital and balance sheet strength correlate much more closely with dividend paying sustainability, i.e. you'll keep paying it, and that you might grow it. And that's why that's kind of at the core of what we do. We start with companies with persistently high return on capital and companies with strong balance sheets, because those are the types of businesses that if they pay a dividend, that it's much likely to be more sustained and grow. If you think about why that's the case, is the first one from a balance sheet perspective, what you're always trying to think about is what could go wrong. So if you've got a balance sheet quite stretched, that's fine. Lots of different businesses, mozzles, if you're a kind of consumer staple business, you probably don't want a very stretched balance sheet because you don't need one. Whereas if you're, a kind of a asset light business and you're trying to grow quickly, maybe you do, maybe that's appropriate. But if you've got quite a stretched balance sheet, the problem you have is if something goes wrong, you've then got a lot of debt to pay off. So what often happens is, a company's going along, it's all great, and it's a brand, right? It's Gucci. Gucci sales go down a lot for some reason. No one likes Gucci anymore. Earnings come down. If you've got a lot of debt, the decision then becomes, what do we do with the cash flows? Do we pay it out as a dividend, or do we just pay down our debt? And the decision quickly becomes pay down the debt, cancel the dividend, or reduce the debt, because that's the not paying the debt is sort of fatal, right? That's the end of your company potentially if you don't. So therefore that happens. So if you've got high debt levels and things, you want to have strong balance sheets. And we found that a lot through the pandemic. So in 2020, half the companies around the globe kind of completely cancelled or cut their dividend. It was a really difficult time. Whereas in our portfolio of 35 companies, in the pandemic year 2020, none of our companies cancelled their dividend, zero. We had one company reduce their dividend by 30%, and that was it. I think we had 6 that were flat, and we had 28 companies grow their dividend through that period. So our dividend distribution was about flat. So actually, we didn't suffer that, and that wasn't just because we're in consumer staple businesses that were doing great because everyone's just trying to buy groceries, right? Yes, we had some of those, but we also had industrial companies that their earnings dropped by 50%. But they were the industrial companies that had strong balance sheets. So when we listened to their managers, they were saying, look, this is really tough, but actually we think we're going to come out of this better because we've got enough, we can take on a little bit more debt. That's fine. We've got some cash on our balance sheet so we can keep paying our dividend, keep paying our staff. And actually, we think we can take market share because some of our competitors don't have that and they're really struggling and they're trying to sell some of their businesses and we're going to buy them. So it's a really key measure, that sort of balance sheet strength. For you don't know when it's going to go wrong, but when it does, you want to have those companies that can weather that. And then if you think about the return on capital argument and the persistency of that, that's just really telling you these are good businesses. And we look back over a decade at that return on capital profile. So that's telling us these companies that we're owning have, in different, through an economic cycle, have done fine. They've done pretty well. They continue to grow. They continue to be able to, reinvest in their business, and their cash flows are probably more consistent and more sustainable, and therefore they're more likely to be able to pay their dividend. So those two things, I think, gives us a lot of confidence in that. The income or the dividends these companies are paying, we're going to get, and we're going to get them sort of through thick and thin. And that gives you a really good starting point. We don't get it right all the time, obviously, but it gives you a much better chance of being right. And I think that's proved itself, as I say, through the last sort of 5 years.
Is Guinness able to influence the decision of a company suspending a dividend at any point?
I would say unlikely, probably. I think these are. I think we certainly talk to companies, and when we do, we're very focused on how do you think about the dividend? Where is it in your decision making? Is it your top priority at the beginning of the year? Is it at the end, we'll see what we've got and then we'll pay some of it out. Do you have a kind of progressive policy where you'd like to grow it every year? Is it just purely pay out? So we really like to talk to managers about how they're thinking about it and where it sits within their sort of decision tree, if you like, and sort of broadly how they're thinking about paying it. And so I think we may have some influence on that. I think I'd minimal, I would say, because generally these companies are pretty mature. They kind of know what they're doing. They've kind of established that. I think ours would be just a little bit more like, I think that's really good what you're doing, encouragement and, kind of making sure that they know that we think it's very important. So if they ever did come to make a decision about cutting, they'd at least be thinking about their investor base and saying, hey, would they be really disappointed? Would they leave the company? Would the company share price fall? So I think that's true. However, I think if a company's in a lot of distress, there's certain things they have to do, right? And they very duty and so forth to keep that company going. I don't think we would have necessarily a lot of influence in a company doing that.
Okay. Can you share with our audience an example of a time when a long-term view on dividends didn't or really paid off? Let's talk about the positive, really paid off.
It really paid off. Yeah, I guess our sort of one of our longest term holdings is Microsoft. So we launched the fund in 2010. That's probably been our best performer. Clearly, it's changed a lot. And I think, if you go all the way back to 2010, Microsoft was seen as a very different business. It was essentially like boring cash cow, not much growth, modest growth. It's got this sort of office suite which will kind of keep ticking over. And it was one of those companies where, particularly in the tech space, it's quite interesting that it was often perceived, if you're a tech company and you initiated a dividend, so you weren't paying a dividend before, now you're going to start paying a dividend. That was basically sort of raising the white flag and saying, look, we can't grow anymore. We're done. We're too big, or so we're just going to have to give cash back to shareholders instead because we can't really reinvest to grow. And I think our view was always, well, that's not really the right way to think about it. This is a sensible decision. This is a company saying, look, we've been successful, we're bigger, and what we really want to maintain is our higher return on investments, because that's actually what drives shareholder returns eventually. You don't want to just sort of keep, there's probably plenty of things they could have bought and plenty of things they could have invested in. But if your kind of return on investment starts to just go down because you're just not finding it's good stuff to put the money to work in, it doesn't look quite as attractive. And I think our view there was, we think that could be a company, that the total return could look really attractive. It's got this great business that's growing. It started to initiate a dividend. That dividend growth has been, pretty high, so double-digit dividend growth, and that I think would give you a really nice return profile. So I think that was sort of a little bit different. So we thought, the growth is actually pretty reasonable, and we like that. We think that's a good decision to pay a dividend. And clearly, things change pretty rapidly through the period. But it's that I'm trying to think. I did the maths the other day. I'm going to get this wrong, but in terms of sort of the kind of the dividend distribution they've got now, as a proportion of what we paid for the company originally, is massive. It's sort of like 25% or something, or 30% yield, if you like, on the initial investment.
Wow.
So that dividend growth, consistent dividend growth over long periods is super attractive in terms of your kind of initial investment. So I think that would be one that has gone incredibly well, I suppose.
But how do you manage the message to your clients when your dividend call on companies doesn't go well?
Yeah, well, hopefully that happens very rarely. And I think, over the life of the fund, we've seen very few kind of dividend cuts. And I think it's just through, very transparent honesty. It's sort of just saying, look, we bought this company for the right reasons. Some of them we would be aware that there's a dividend risk. That might be therefore why we sell the company, number one, before it cuts. And we've definitely held companies, decided the dividend's at risk, sold them, and then 6 months down the line, they've cancelled their dividend or whatever, right? So we've kind of avoided that sort of cut. But examples where things can cut is, I'm trying to think more recently. I went to a company called VF, so they kind of make Vans, trainers, North Face jackets, etc., consumer discretionary stock. performed quite well for us in the portfolio. We then had a pandemic period, so clearly a lot of those consumer discretionary stocks fell. They actually paid their dividend through that period. But coming out of it, they'd actually done a few acquisitions, or one particularly big acquisition, not massive, but big enough that it expanded their balance sheet just at the wrong time. I think they're a bit unlucky. And we sort of held on to, we're talking, hearing what management was saying, things are picking up. We think that, we're going to use some of our cash to pay down debt more quickly. It all looked okay. And then ultimately their business just didn't quite grow as fast as it might have done. And I think where we were wrong, I guess, is we weren't quite focused on their vans trainers business, which was a big part of their growth driver. But there was a lot of noise, right? It was all pandemic and this, it was quite hard to see. But that would be one where eventually, the board got rid of the management team, they brought in the new management team, and that new management team said, we're taking a different view here. We're going to reduce the dividend. We're going to use that cash to do other things. And this is how we're going to turn it around. And so I think that would be one where, was the one sort of dividend reduction that we saw last year, for example.
Okay. And Ian, tell me, for someone who is just starting out with dividend investing, what would your top piece of advice be to them?
Yeah, I mean, I'll probably sound a bit like a broken record, but I'd be saying, think really, I'd just be saying, try and think about what your overall total return is going to look like. So don't, it's the sort of siren call, if you like, of a 6% dividend yield. Looks, you think, wow, that's really attractive, right? I can buy that, and then it's a bit like a bot, I'm going to get that, and then brilliant. But just be aware, sort of how much you think about how much you're paying for that income, right? In terms of the lost growth you might not get, right? So I think I'd just be, try and think about, if you're comparing strategies, if something's got a high dividend yield, compare it to something else. And then plot it over a long period and say, what does that look like? How much income am I going to get each year? And then how much growth did I get? And then add them both up. And I think what you'll end up with thinking is like, well, actually, I think I'd rather go with a more moderate yield in the short term, because then in the long term, I think I'd get a better result. And I think, you can always sell a bit of capital if you want more income, right? You've got a 3% dividend yield, and that year, you're living off it as a pension, say, you could always sell a little bit of your underlying assets to boost it up to 5%, right? Now, you've got to be careful, your individual tax circumstances and so forth may, you'd have to sort of think about that on a personal level, but you can kind of do that, right? And actually, if you did that, you might end up with a bigger pot and a better return than if you just took the 6% yielder and just got the income for 6%, right? So just think about it in those terms, I'd say.
And I'm going to cut to questions from the audience. Our audience have been quite busy. Thank you to the audience for posting your questions. I've got one from Robin. In a world where interest rates are about to start changing, how do changes in interest rates influence dividend-paying stocks, and what strategies can investors employ to navigate these shifts?
Yes, that's a great question. I think, we're definitely at this inflection point where, the market's been super focused on, dividend cuts. I think the way to sort of think about it is, in terms of the sort of duration risk, if you like, in terms of an equity income strategy, we're clearly we think we're lower duration, right? We haven't got as many sort of like bond proxy type stocks. So therefore that impact of those sort of interest rate sensitivity, I think in our particular strategy is somewhat less, because we've got that kind of growth in terms of the portfolio. But I think the other thing to think about is kind of what's the overall growth going to look like in the future, the next 10 years, because it could be quite different to what we've seen in the last 10 years. We know interest rates might be coming down, but I think it's unlikely they're going to go back to that kind of zero bound that we've been very used to kind of post the financial crisis. So maybe I think an interesting way to think about it is perhaps we're going to be in a kind of lower growth period. So not necessarily, could be recessionary. That's what everyone was worried about yesterday. Who knows what they're going to be worried about tomorrow? But let's just say interest rates are going to be higher than they were last decade. Inflation's probably going to be higher than it was last decade. It's probably less likely we're going to get kind of significant stimulus measures in terms of QE, etc. And we've seen a lot of kind of deglobalization. Supply chains have been cut and moved around, so kind of costs are a bit higher. So that sort of there's quite a lot of structural differences there. And we, by the way, have quite high equity market multiples, which again, if you took on average,
Yes.
expect a lower return. So let's say that next 10 years, you're going to have a lower total return. Could be positive, but it might be lower, I think, than we have seen. Now, what's interesting there from a dividend perspective is if you look at the S&P 500 and you say, let's look at different decades. If you look at kind of high growth decades like the 90s or the 2000s, the dividend as part of your total return accounts for about 25%. So it's pretty meaningful, but it's more about growth at that point by growth companies. If you look at low growth decades like the 1940s or the 1970s, your dividend accounts for about 75% of your total return. Not because the
That
dividend,
high.
yeah, it's very high. It's not because the dividend is higher. It's just the dividend's about the same, but your total return is way lower. So we're not saying it's going to be the 40s, it's going to be the 70s exactly, right? But we're just saying, hey, in a low growth decade, that your dividend will become a greater proportion of your more moderate growth, and in a more sort of lower growth environment. So bigger proportion of your total return. And that is really interesting because I think that's a really good way, why would you buy an equity income fund today? But if you think you're going to be in a low growth decade, that income stream is going to become more relevant in terms of your total return. And therefore, those types of companies should be rewarded. And I think that would be sort of the big thing I would be sort of advocating for in terms of why is it particularly interesting at the moment. And I think the other thing you think about that is, what else have we seen companies doing? So if you look at those big tech companies, Meta just announced a dividend for the first time. Salesforce just announced a dividend that they're going to pay for the first time. And there's other examples. Alphabet just announced a dividend for the first time. And I think that's an indication that what clients are saying to them, investors are saying to them is, we want to see cash and returns. We want to see your profitability, please. We like a dividend, and that's a flag of, hey, we hear you, and we're not going to just be, spending money here and everywhere. We're going to be like, well, actually, here's some cash back to you. Here's our buyback plan, and then this is what we're going to do with the rest of it. So again, you can see the other examples in the market beyond just that kind of low growth, high proportion of the dividend argument, that things are sort of pointing towards a little bit that kind of dividends becoming a bit more in favour. Because ultimately they've been pretty out of favour. It's all been about FANG stocks and AI stocks and the Magnificent Seven. But actually, they, that sort of slow and type business that can grow nicely and pay the dividend can become very attractive, and they might be more undervalued as well at the moment. So you've got an opportunity for a re-rating, whereas I think with a lot of the big growth stocks, I think not necessarily so, right? They've already had their re-rating. They're going to go up more. Their growth going to accelerate. Yeah. I think they could still do quite well, by the way, but that argument I think is a bit stronger for the equity income strategy.
Here's another question from Martin. Thank you for your question, Martin. How do you see the BRICS sector affecting future markets with the objective of de-dollarization?
Well, that's a complicated one. I think de-dollarization, I think that's a stretch. I mean, perhaps Martin knows better than I do in terms of the likelihood of that occurring. So then we've sort of seen that a lot. I think the barriers to achieve that, i.e. kind of reducing the influence of sort of the US dollar being the kind of global currency, whether it's through CNY or RMB in China or otherwise, or it's like petrodollars to start previously. I think maybe it's the Indian rupee will be the next thing. I think it's in the short term, it seems very, very hard to think about how that would happen in a meaningfully large way. Very long time periods, potentially. I don't think I'd have a very strong view on that. But I think, in terms of how we invest, we are global investors. We own companies both listed across the globe, but all have global exposure. So, when we're talking about a lot of these big businesses, they are earning their revenues through lots of different currencies. If you're a big US business, it's not all the US market, right? You're in Europe and with receiving euros, and you're in India receiving rupees, and you're in Australia dollar, and China, and you're all over the world, and you're kind of bringing them back through. So I think in that sense, there's some companies that are going to be more affected by that because they're kind of more domestically focused, and then exporting, they're going to be much more impacted than a kind of globally diversified business. So I'm afraid that's not the best answer. It's a bit wishy-washy, I'm afraid, but I think I think short term, I don't think it's something we're looking at in a big way. And then longer term, I'd be thinking, hey, these are globally diversified businesses, so I think that'll maybe have less impact on the types of companies we would typically look at.
Yeah, and we talked a little bit about balance sheet strength. We've got a question from Frank who says, what ratio do you look at between equity and debt that supports a quality business?
That's a great question. And we look at it, you've got to look at it lots of different ways, I think, is the first thing. One sort of balance sheet strength metric on its own can be good for some companies and not so useful for others. So we think about it in both sort of debt to equity, just gross debt to equity. So we're kind of generally looking less than 150%. We're looking at net debt to equity, generally less than 100%. And then we're also thinking about kind of net debt EBITDA metrics, and typically looking kind of less than sort of 3 times is ideally what we'd like to see. And the reason we do that is if you just took a debt to equity measure, equity you can find is actually that metric can be quite skewed for some really good companies that actually don't have stretched balance sheets. So I'm trying to think of a good example. I think it's McDonald's would be a good one to look at, because what they've done is they've done huge amounts of buybacks over time, and then because of accounting principles, when they buy back shares, that sits as within the kind of shareholder equity line, and it can kind of cancel it out. So all of a sudden, your equity gets really, really small because you've got this excess, the shares you bought back, which they haven't cancelled yet within the equity piece. So therefore, your debt to equity looks enormous for something like McDonald's, whereas actually it's fine. It's just that particular, they bought back loads of shares. That's probably a good thing, right? Equity is really small. So if you then look at McDonald's on a net debt to EBITDA metric, it looks totally different. And if you looked at it on a interest cover, it's probably 20 times or more. I haven't looked at it closely, but huge. So just when you're thinking about balance sheet strength, I would say, just a reminder, you've got to look at lots of different things. You've got to look at kind of net debt to equities. You've got to look at EBITDA, so it's kind of above that line, so you kind of avoid some of those kind of characteristics. And then interest cover from a kind of practical point of view, kind of what it looks like. And you can look at kind of cash flow cover and the dividend stuff too. That's how we think about it.
And last question from me. If
Okay.
you weren't a fund manager, what would you do? What do you do for fun?
Well, I mean, I'd love to be a sportsman. I mean, that's the dream scenario. But clearly, actual ability versus what you might achieve is probably different. So I think, in a practical sense, I think if I wasn't a fund manager, what would I do? I don't know really. I think sort of the easy answer would be probably something in science, sort of science, scientific research or something. I think I probably, I could have done. But I think I'd probably like to run my own business of some description. I think was probably what I'd enjoy most. I think kind of what that might look like, I'd have to kind of think about. But I think that slightly more sort of entrepreneurial spirit, I think would be something I'd really like to have thought I could have done anyway. Who knows if I'd have been successful or not.
That's interesting, but I suppose with your scientific background, you could do something exciting and sell it off to the rest of the world, right? And then somebody could buy your company
Exactly,
and pay
yeah.
dividends.
Maybe I could be an astronaut. I think I was too tall, I think, actually, technically. But I did look at once being a pilot. And I think British Airways, I think you have to be less than 6'2". I'm 6'3", so that was out the door first of all. So maybe I think there's quite a lot of physicists that become astronauts for various reasons.
So INN8 has an astronaut as well. I don't know if you met them, but we can put you in touch. We
Is that right?
definitely
Okay,
can.
brilliant.
Okay. I'd like to thank the audience for joining us and for all of the questions. And thank you to Ian for giving us such insight into the world of dividends. The Guinness Global Equity Income Fund is currently available on INN8 offshore platform, and we're in the process of looking to add a few more. Please speak to your specialist investment consultant for more information on the INN8 offshore platform. Our next In the Room series will be with 91. Look out for the invites. And all that's left for me to say is thank you very much and have a very good weekend.
INN8 is a registered trademark of Stanlib Wealth Management Pty Limited, an authorised financial services provider.